Robert J. Shiller, Irrational Exuberance. In Irrational Exuberance, economist Robert J. Shiller examines the factors driving widespread overvaluation in the late 1990s stock market and the post-2000 real estate market. He argues that investors tend to act irrationally, contrary to orthodox financial theory, which assumes rational decision-making. Shiller highlights historical examples of speculative irrationality and explores the impact of unreasonable expectations, cultural changes, media influence, and demographic shifts on financial markets. This book offers insight into the psychological basis of speculative bubbles and equips the reader with valuable knowledge to recognize potentially unsustainable market trends.
Irrational investment. The economic system assumes that investors make rational decisions. However, substantial evidence suggests that their investment decisions are irrational. In the late 1990s, investors invested in the highly overvalued stock market based on their irrational beliefs. Even when the stock market was at an all-time high, people kept buying stocks despite being out of line with traditional relationships and fundamental values. After the 2000 crash, they transferred their almost superstitious belief in the unfailing market ascent from stocks to real estate instead of learning to be more conservative. The median price of homes equaled 7.7 years of per capita income by 2002 compared to 4.9 years in 1985, which even newspapers have started to call a bubble. This summary questions the core assumptions of modern-day economics and sheds light on the irrational nature of investors' decisions. The real estate and stock market bubble of the 90s. Between 1994 and 2000, the Dow Jones Industrial Average tripled despite stagnant personal income and the gross domestic product. The rise in stock prices was unjustified by earnings and corporate profits that grew at slower rates. The real estate market experienced an unprecedented increase, driven largely by speculation in the late 1990s through 2004. This boom was not fundamentally supported and had no correlation to population growth, interest rates, or construction costs. People were buying homes like they bought stocks in the 90s, convinced that prices can only go up. However, house prices had historically compounded at 0.4% per year, and most of the land in the U.S. is still empty. The irrational belief that prices must go up is unfounded and unsupported by financial history. Beware of high price-earnings ratios. High price-earnings ratios lead to low returns and potential market crashes. The housing market is also susceptible to speculative booms. Did you know that high price-earnings ratios usually result in low or negative returns? In January 2000, the price-earnings ratio hit an all-time high of 44.3, and precedents for such a high ratio were almost non-existent. In 1929, a high ratio of 32.6 led to the famous market crash, and the S&P index didn't return to its pre-crash value until almost 30 years later. The third instance of a high ratio occurred in January 1966, leading to a 56% drop in real prices by 1975. Unfortunately, there is no similar data available for the housing market since it was not previously considered a speculative investment. However, recent years have seen a significant rise in speculative investment in owner-occupied homes and their subsequent booms. It's essential to be wary of high price-earnings ratios and the potential for market crashes in both the stock and housing markets. This book offers valuable insights into investing wisely and avoiding significant losses. The 12 factors that inflated economic bubbles. Economic booms in the 80s and 90s saw unprecedented rises in real estate and stock market prices, leading to the question of what caused these bubbles to occur. While the factors behind these economic trends are difficult to define, 12 factors are likely to have played a significant role. One obvious factor was the ownership society, reinforced by the fall of the Berlin Wall and China's shift to a market economy, which convinced people that capitalist ideals were good for everyone. Additionally, cultural shifts towards materialism and the erosion of worker solidarity may have contributed to increased interest in stock and real estate speculation. New technologies, while critical, are not always economically predictable, and their impact during the 90s bubble exceeded their actual value. Federal Reserve policy, demographic changes like the baby boom, business news, analyst optimism, the decline of inflation, and the expansion of trading opportunities all played a role in inflating the bubble. Finally, the proliferation of gambling may have encouraged other forms of risk-taking. While these factors may not have caused the bubbles, they likely helped contribute to them, leading to a major shift in the way we view economics and investments. The dangers of irrational exuberance. The human emotion of confidence and eagerness drives investment decisions as much as quantitative analysis. As prices rise, exuberance enhances investor confidence, reducing perceived risk. This cycle repeats and draws in more investors, creating a speculative bubble. The pattern of irrational exuberance has led to many failed new eras in the 20th century, including investment trusts in 1901, industrialization in 1929, Johnson's Great Society in the 60s, and the Internet in the 1990s. The current surge of new era thinking in the real estate market should be viewed as a warning.
Shiller's analysis in Irrational Exuberance demonstrates that the investing public often falls prey to unreasonable optimism, leading to unsustainable market bubbles in stocks and real estate. By examining the historical precedents and contemporary factors that contribute to such bubbles, he uncovers the crucial role of human psychology, demographics, and media in driving market behavior. The book serves as an important reminder that, far from being rational players, investors are highly susceptible to herd mentality and emotional reactions. In order to navigate the complex world of financial markets, it is vital for individuals to recognize these tendencies and maintain a level-headed approach to investment decisions.